Okay, Mr. Foster, if you can proceed.
Okay, if we weren't online, I will call the meeting to order once again. And as per our agenda, we will proceed with the opening statement from Legal Services.
Yes, sir. For the record, I want to note this is a regular meeting of the CERS Actuarial Committee. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and not appearing by video, please identify yourself before talking. In the event the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date. Thank you.
Hey, Sherry, would you proceed with the roll call, please?
Yes, sir. Mr. Foster,
Here.
Dr. Carver,
Here.
and Dr. Hackbart.
Here.
Thank you.
Are there any public comments?
No, sir, no public comment.
All righty, we'll proceed with the review of the minutes of our April meeting. Are there any additions or corrections to those minutes? Seeing none, is there a motion to approve the minutes as presented?
So moved.
Second.
Covered motions, second by Dr. Hackbart. All in favor of approving that motion, please say aye.
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 Anyone opposed? Seeing none, the minutes are approved as presented. All right, let's get into the weeds here now. In terms of going over the draft actuarial evaluation. And Danny, are you? I don't know who's presenting that.
Mr. Foster, yes, I am. We are online. GRS is ready.
Great, good deal. Proceed, please.
Thank you. My name is Danny White with Gabriel Smith. Joining me is with Janie Shaw and Christy Kiesel. We have a deep bench of people that associates that are working on the vows, and we work on them feverishly during the last couple of months. So here you've seen the results of this. While it is draft, we do consider them to be final. We're going to generally come in with favorable results, and I'm actually going to turn this part of the presentation over to Janie and Christy to go over those results, and you'll see me again later on down the agenda.
Thank you, Danny. Like Danny said, we're here to talk about the June 30, 2023 actuarial evaluation results. I just want to take a second to thank the committee members today for giving us the opportunity to present these results. And I also want to take a second, Rebecca also did a great introduction for us, but I want to take a second to introduce board members to Christy Kiesel. She's a very valuable member of our GRS team that we're here to introduce you to today. She has been part of the team for a very long time. So it's an honor to introduce her to you guys today. But we will go ahead and get started. So we're going to take you through the evaluation results today. I'm going to talk to you about what has changed from this year, the 2023 results, compared to last year. We're going to take a look at what that does to your contribution rates and your unfunded liability. And then I'm actually going to turn it over to Christy to take a deeper look into your membership and a deeper dive into your evaluation results, and then also look at a projection of your unfunded liability and your contribution requirements. So let's get started. So the board members may remember, we were here back in May to talk about the experience study. And what you may remember from that experience study is we took a deep dive into your actuarial assumptions. And in general, when we looked at those actuarial assumptions, most of those assumptions remained reasonable. But we did recommend a few updates for those assumptions. And kind of a high level look at what those updates were is the board adopted a new investment return assumption, increased it to 6.5% for all funds, both pension and insurance. We also changed your mortality assumption, increased those base mortality rates to reflect recent experience. And we also increased the rates of termination prior to retirement. So decreasing the probability that a member reaches retirement. So ultimately what this did is it decreased our unfunded liability and decreased those contribution rates. So that was a change in assumption that we saw from the prior year. If we move on to the next slide. Another change that we saw is we saw an increase in your active membership and an increase in your membership payroll. So pretty significant increase in your membership payroll from the prior year. We saw an 8% increase for your non-hazardous fund and a 9% increase for your hazardous fund. So we talk about an increase in your membership payroll. We're talking about how you collect contributions. So when you collect contributions on your membership payroll, an increase in your membership payroll is going to drive down those contribution rates. So there's really two things that underlie an increase in your membership payroll. One is an increase in your active membership. We did see an increase in your active membership this year. And then also what we'll talk about in a few slides is actually an increase in the salary increases for your current active membership. So there's really two main things that we're talking about there, and we will talk about that again in a few slides. So again, an increase in your active membership, that's going to bring down those contribution rates. So if we actually go back to that slide. So one other thing I want to talk about here is we did see one piece of legislation that passed in 2023. That was House Bill 506 that reinstated the partial lump sum option and also adjusted the minimum separation period for return to work. This had a very minimal change to your non-hazardous fund. So we're going to start on your asset side of things. So we're talking about your investment experience for 2023. We saw a 10% return on your market value of assets. I'm going to get into the weeds a little bit here, but that 10% is higher than your assumed rate of return of 6.25%. We're actually comparing it to that old 6.25% return because that was your return for the prior year. Going forward, we're going to compare it to that 6.5% that we just adopted there. But either way, that 10% return on your market value of assets is higher than your assumption. And so what does that really mean? That means that your fund assets were $601 million more than we were expecting. But remember, when we calculate your contribution rates, when we calculate that unfunded liability, we're actually using an actuarial value of assets. We often refer to that as your smoothed value of assets. So we're going to smooth in those asset gains over 5 years. We're bringing in some deferred asset losses that we had from prior years. So we actually had a $44 million gain this year, which really just means that your actuarial value assets was $44 million higher than we were expecting. So that's the asset side of things. We're looking the next slide. We're going to talk about the liability side of things. So ignoring the assumption changes that we talked about earlier, your actuarial accrued liability for your retirement funds was $328 million higher than we were expecting. And this is going to come back to the salary increases that we just talked about. That increase in your liability was primarily due to those salary increases for your active members. So higher salary increases for your active members, what that means is higher benefits that are accruing. So that was the primarily driver behind that liability loss that we saw in your retirement funds. Talking about your insurance, looking at the insurance funds, we saw $331 million higher liability on your insurance funds as well. And that's really primarily driven through your premium experience. Insurance funds are generally driven by your premium experience. So your 2024 pre-Medicare premiums were higher than we were expecting, partially offset by the fact that your Medicare premiums were lower than we were expecting. So ultimately, where does this bring us? What does this mean for your employers? What does this mean for your contribution rates? What does this bring us to? But what this ultimately means is a decrease in your contribution requirements. So looking at this slide here, we can see the current contribution rates that we have in effect today. That is going to be column 2 and column 4 there. So the current contribution rates that went into effect July 1st, 2023, those were based on the 2022 valuation. That's the 23.34% and the 43.69%. So the results that we're bringing you here today is the 2023 valuation. Those contribution rates are going to go into effect July 1st, 2024, often referred to as the fiscal year 2025. So you can see those contribution rates are going down across the board pretty significantly. The main driver that we're seeing there is one, the experience study that we talked about, those assumption changes that we talked about, and 2, the increase in that total membership payroll that we talked about. Those are the main drivers of why we're seeing those contribution rates come down. Looking at the next slide there, what does this mean in terms of dollar amounts? So we can see in terms of dollar amounts, those contribution requirements coming down about $57 million for the non-hazardous fund, about $7 million for the hazardous fund there. In terms of unfunded liability, good news here as well. We're seeing our unfunded liability come down 840 million for the non-hazardous fund and 200 million for the hazardous fund. Again, so we have fully phased in those actuarially determined rates now. So we're paying the full actuarially determined rates. Those are fully phased in. So we do expect this unfunded liability to come down each year going into the future, which is good news. We want to see this unfunded liability be systematically paid off. This year's valuation, we actually saw that unfunded liability come down more than we were expecting. And again, the big driver behind that is going to be those assumption changes. So even though we did see those liability losses, those assumption changes did drive down that unfunded liability. So kind of at a high level, good news across the board. We're seeing that unfunded liability come down. We're systematically paying that off. We saw those contribution rates come down due to those that covered payroll coming up. So really good news on what we want to see happen in our valuation results. So I'm actually going to pause right there, see if there's any questions, comments from the board members before I turn it over to Christy. Not seeing any, I'm going to turn it over to Christy.
Thank you, Janie. So if we move on to that next slide here, we're just going to start looking a little further in depth. A lot of this is just a closer look at the things that Janie has already said. But on this first slide, we're just looking at your membership. As you can see, over the last year, we did see a membership increase on both sides, so both on that non-hazardous and hazardous plan. As Janie mentioned, this on its own is going to lead into a little bit of an increase that we're going to see on that payroll side as well. However, overall, the last 10 years, the increases have been fairly level, and we do assume when we look later, we do assume generally 0% increase in assumption or increase in population. So we kind of expect it to remain stable. As we go into the next slide, we see the really big hike in the payroll over the year. So this, as Janie mentioned before, the really big driver here is the payroll is what we base our contributions on. So as much as that payroll is increasing, that's also helping us bring down that contribution rate as a percent of pay. Over the last 10 years, you have been seeing on the non-hazardous side approximately a 2% increase in payroll, and that is in line with our assumption. So we assume that the overall payroll growth from year to year is about 2%. So historically, we are seeing that pattern on the non-hazardous side. On the hazardous side, there's a little bit more volatility in those rates here, but overall, we are seeing a lower average increase versus this really large increases that we saw in the last year. If we move on to the next slide, we're looking at the retired membership count. There's nothing surprising here. This is exactly as we expect. From year to year, we expect the members in payment status to increase. People are going to retire, move out of the system faster than those who are already receiving benefits are going to stop receiving benefits. Therefore, we expect this to continue increasing as the plan continues in the future. Similarly, on the next slide, the benefits, if there are more people to be paying benefits to, we expect those benefits to increase. So nothing surprising here, just showing you an overall trend of how these increases are occurring year to year, and that, you know, keeping in mind, as we expect, as more people retire, we are expected to pay more benefits. There are more obligations from the system. So on to the next slide. Here's just a more in-depth look at what has happened to each of these systems over the last year. So the first rate we're looking at here is the total normal cost rate. This is the cost of accruing your next year's benefit. So everyone who's currently in the system, what is that cost of them accruing that one more year of benefit? From 2022 to 2023, you will see in all categories that this rate is decreasing. We'll continue to see that as you're phasing in those tier 3 members, because the cost of their benefits is less than those older tiers, and that is in nature how the plan was designed. And so we will continue to see those rates creep down as more and more tier 3 members are entering that group. The membership rates, you will see, those are their contribution rates. So what are the members contributing into the plan? And you'll see the insurance, we have slight increases, and that's as we're phasing in more and more of those tier 2 and tier 3 members who are contributing that 1% to the health insurance plan. So again, as those people continue to phase in, we'll expect to see that cost in contribution slowly increasing to that 1%. So when we net that out, the employer normal cost rate is really just what portion of that next year's benefit is the employer paying versus the employee once we take that employee contribution out. The next thing that comes into this is our admin expenses. So we just make sure that we are including that in your year-to-year contribution rate, understanding all the expenses that go into the plan. And then finally, that amortization cost is going to be the cost of paying off your unfunded accrued liability. As we can see for both pension plans, that is the largest portion of your actuarial determined contribution right now. But we can see that that cost did come down, and that is from 2022 to 2023, and that is going to be due primarily to those assumption changes as well as that payroll, as Janie mentioned. Overall, that brings us to our total actuarial determined contribution rate. And from year to year, we saw a pretty large decrease, as you guys saw on a couple slides ago. And that is due primarily to those changes in assumptions, as well as that much larger membership payroll base, making that number smaller as a percentage of payroll and really helping bring down that actuarial determined contribution rate. Finally, on that small bit here, sorry, I'm still that little section left. Your accrued liability. So these are just all of your prior benefits that have accrued in the system. So what is owed to all those members that they've currently built up in the past. We can see that this number came down across the board, and that is, or across the board on the pension side, primarily due to those assumption changes. It did increase slightly on the insurance side, and that's due to that premium experience that Janie talked about. Overall, our actuarial value of assets increased due to really good returns on our market value of assets. So the actuarial value is also referred to as our smoothed value. So it is slightly different than that market value, because we are going to try to mitigate against that volatility that we see in the market from year to year and keep a more level asset value. So that's what we're basing our decision making on. And then we have our unfunded liability, which is just that shortfall between our accrued liability and our actuarial value of assets. Overall, we saw that come down on the pension side, again, due to those assumption changes, and it increased a little bit due to that liability increase due to the premium experience. Overall, that resulted in our funded ratio, which is comparing our actuarial value of assets to our accrued liabilities. And generally, we saw really good experience here. So we did see increases on the pension side, and the insurance both stayed above 100% on their funded ratio. So now that we have really covered where the plan is at today as of June 30th of 2023, we're going to move forward and look at where the plan is headed with some projections. So on the next slide, we just want to point out some of the things that go into the projections. Something that's really important to keep in mind is that we are assuming in each future year that all actuarial assumptions are met. This includes our annual return of 6.5% and all of those other things that we put into the valuation. We also are assuming that your actuarial determined contribution is being paid in each year. We have no reason to believe that wouldn't be the case. So that is what we make sure goes into these projections. As mentioned before, when we looked at the membership payroll, we also assume that your payroll is going to increase by 2% each year, while the active population remains level. So as people are leaving the system, we expect them to be replaced at the same rate. Now into the actual projections. We're going to take a look at the non-hazardous plan first. And the main thing to note here is that we expect the unfunded accrued liability to continue to decrease in all future years, And along with that, we expect the funded ratio to increase in all future years. We also expect the contribution rate to remain fairly stable. We are seeing increases as we see that payroll increase. So since we are contributing as a percent of pay, we will see the contributions increase along with those increases in the payroll. You will see after the plan is expected to be fully funded that the contribution rate decreases down to just that normal cost rate. So you're just expected to continue to pay the cost of accruing a benefit for each future year. We do keep the same scale between the contributions on the insurance and pension side, just so you can see the relative magnitude of what's going into each fund. There's not much to note on the insurance side, since the good news here, they are projected to stay above 100% funded, which also means we expect it to continue to be a 0% contribution rate. However, it is important to note those assumptions that are going into these projections, and things can change. Things do change. So as much as we are projecting for it to stay there right now, that doesn't mean something might not change, and we might have to consider that in the future. But at the moment, good news on the insurance side, it's expected to remain fully funded and stay at a $0 contribution rate. On to the hazardous plans. We're really seeing the same story here. So, not to be a broken record, but we continue to expect that unfunded liability to decrease, funded ratio to increase. Our contributions are expected to remain level as a percent of pay, increase as a dollar amount with the pay increases. On the insurance side here, we do see that it is expected to remain really well funded. We are seeing a little bit of a dip in the funded ratio on the insurance side, which then has a corresponding increase to the contribution amount. And that's really just going to be due to the lag in timing between when we determine the actual determined contribution rate and when it starts being contributed next year. So there's just a little bit that happens there, but generally it's expected to maintain a strong funding position moving forward. And then finally, we are just overall, as Janie mentioned, it's good news, but it's still really important that all participating employers are continuing to contribute that actuarial determined contribution rate in each future year so that the plan stays on a good path. And then the big thing this year was really just that increase in active membership payroll. It's a really good sign for the system, and it really helped bring down those contribution rates.
Yeah, I think this year when we came in, we knew the tailwind was coming in with the assumption changes. That was known in May. And what just kind of added to it was seeing the change in the number of employees participating in the active membership in the system. Seemed like the participating employers were providing probably much needed pay increases to their employees. So again, even though the contribution rate may change or may go down in terms of dollar amounts, you're maintaining the same dollar amount into the fund, which is the direction you hope to see it go, because we've seen it occur on the K non-as years ago. What happens if it goes the other way? You get unsustainable contribution rates. So this should all be seen. I mean, we certainly see it as positive news, bringing to this committee and ultimately the board. We will open up to any questions or discussion.
Yeah, I have a question. I'm trying to digest all this as you presented, and I appreciate your report. But in summary, what I'm hearing is that our return on investment is 10% higher than expected, which is good. Our assets have increased, which is good. Our unfunded, our liability has increased slightly, and the unfunded liability has went down, and the insurance is fully funded. So where's the bad news?
Well, we've had many years of delivering bad news in prior years, so we've came in with that fair share. I'm happy to say, you know, if you will write down in your journal or your diary this year that we came in with good news, because it doesn't always happen. But you know, this is about as positive as it gets when it comes from us.
Well, in addition there too, certainly in the short term, I'm talking about short term, 20 years, increase in membership, that should strengthen the fund also, should it not?
That's healthy for the fund, yeah.
Hey, Mike. I think the bad news is we still have a huge amount of unfunded liability. And there's no assurance that the employers are necessarily going to pay what they're supposed to pay. That's the only bad news I can see.
Well, I understand, but the
That is a fair amount.
system so that they, you know, that would be that happens in any system. Sometimes your
Yeah.
contribution could increase and you're expected to pay.
Yeah,
Uh,
I agree. I agree. It's a great report.
Mr. Eager does bring a great comment about the funded ratio. We do have a ways to go. So, I mean, it's the contribution rates as they go down, they're still fairly elevated compared to other public systems, but that's where they need to be to continue to improve the funding of the system.
Were you able were you able to run the numbers in terms of, had we not changed the anticipated from 6.25 to 6.5?
That was a major change. That was probably half. I'm just gonna go from the ballpark or shoot from the hip and say that's about probably about half your experience in the change in the rate. The change in the rate. So you saw
So I guess my question is the change in the funding ratio just a matter of a function of that change?
yes, it did. There was partially. That was probably the most single contributing factor for the change. I would say that maybe accounted for half of that.
Yes. So I think we have to look at this realistically. That was change as a result of just changing that ratio, I mean, changing that percentage.
Yeah. But you knew that in May. So as I mentioned before, that if you were pull open the May report, when we present the options,
Mhm.
you know, that part was known. And then what we've come in today is even better than, slightly better than that estimate.
You know, there was some concern about changing that rate expressed last May.
The rest of the contents in here and that's in your packet is the actual report itself, which is about 100 pages. There's sensitivity analysis that KPPA will pass on to the LRC regarding changes in, you know, what would happen if the discount rate was changed plus or minus, inflation assumption was changed plus or minus, or the payroll growth assumption was changed plus or minus. So you can see the impact on there. But this presentation is to provide a summary of that information that's in that report.
Are there other questions or comments?
Can I, Mr. Foster, we have to report to the LRC once the full board sees the report, so we will not be forwarding all of these to them until next week when your full board sees it. But we have given them contribution rates. So GRS prepared for us like a certification letter to the KPPA board, which had all of them in there. So today I sent that to LRC and to the Office of the State Budget Director because they both use that as they work on the budget bills. So it is going out. We are required to give all of this to PPOB and LRC by the 15th of November. So all those reports will go out soon.
Well, is it the challenge of this committee, I'm asking, to have a recommendation to the full board about the contribution rate? I mean, is that where we are? Silence.
Yes, Mike.
Yeah. Well, based on what we heard, what would be a viable recommendation?
Mike, I think a motion that would send the draft valuation to the entire board for their approval would be in order.
Well, is there a rate there though that would be, I mean, that's the ultimate decision, is it not? What the rate would be?
It's sort of implied by the report, isn't that the case?
The
Am I
rate
correct?
issue is on the next item.
Mhm.
I believe the way the calendars are set up is it goes for the full board in the next full board meeting. That is then accepted as information. And then there's another CERS board meeting in December where the valuation reports are again brought up for possible discussion and then ultimately adoption, which would make the contribution rates effective.
That's right, Danny. What you'll do in November, the actuary committee looks at the report. So it's this recommendation is really about the report itself, not particularly the contribution rates, but that you're accepting the report. And then we'll bring it back. Last year, I believe that Ms. Pendergrass wrote a memo to the board recommending the adoption of contribution rates. That happens in the first week of December. It's about the same time that you look at you're looking at the ACVRs, you're looking at the internal audit and the actuarial report that all kind of rolls up together, and you look at the contribution rates. We send that for the budget bill. The budget bill could change your rates, but they rarely do. You know, pretty much the CERS board is setting their rates every year.
So we're
So I
simply
make a motion that we accept the report and have it presented to the full board.
Is that a motion, Dr. Carver?
Yes, it is.
Is there a second to that motion?
Second.
Okay, Dr. Hackbar. Now, is there any discussion on the motion or any other clarifications that anyone may be needing? When is the full board meeting? It meets in December? Is that what you said?
November 8th, so next Wednesday.
Yeah, I know that, but I saw somebody just mentioned December.
That's when we meet again to recommend the rate. Is that correct, Ed?
Yeah, that's my
Yes.
question too, yeah. It's a
Yeah,
timing issue, it seems to me, Ed, but I'm trying to get a handle on this.
That will
process.
be to send the report to the LRC and to PPOB by the 15th. And then in December, the board will come back and approve the contribution rates.
Okay, that's my question. Thank you for that clarification.
I have that on my calendar for December 4th currently.
So
That is
this-
correct.
So today, this is information, background information, really.
Today's information, the CRS, the November 8th board meeting will be for information. And then December 4th, it'll be more discussion and then adoption, action.
Yeah, if I looked at my calendar, I would have seen the December meeting. I apologize for that, but at the time, we need to do something for the first of the year, so that's what that, it was just a timing issue in my mind. So the motion is to send that report to the full board.
Yes.
Yes. Mhm.
Is there any more discussion on the issue? It's been moved and properly seconded. Okay, so this is a committee recommendation, so all in favor of doing so, please say aye.
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 Is anyone opposed? Okay, we will forward that on then for consideration by the board.
So there will be a presentation like this at the full board meeting then on the 8th. Is that correct?
That is correct. Actually, it would be the same presentation.
Good. Okay.
That's good. I mean, yeah, exactly. I guess. Are you you guys
If-
charging by the pound or the hour?
If you can improve it between now and then, we can be flexible.
Okay.
Actually,
Hey,
the answer to that question is they have a retainer fee, a fixed monthly retainer.
It is a retainer, and the Zoom calls actually, we try to utilize them to benefit, because it brings the board to see other team members that also do work for KPPA, and then also it's an opportunity for our less seasoned associates to get experience presenting in front of so boards like yourself and committees like yourself. So it's an investment on us.
Danny, I can say that in jest because I've been accused of charging by the pound of some of the briefs I've written over the years. So I wanted to say it to someone else. So
That's right. You're gonna earn your money on the next one.
okay, is there anything else we need to take up today?
Yes, Mike. We're gonna talk about the annuity rate.
Okay,
And I'll start us off with that if that's okay.
sure.
Danny's gonna take over the bulk of this conversation, but I just wanted to preface it by saying that the actuarial administrative factors that are used in optional payment, which would be tier 3, what it would cost for members to purchase credit, that was last reviewed in 2018. And so that would have been prior to 2021 with a complete separation of the C board. But in 2018, it was determined that the assumed rate that would be used to determine those factors would be 5.25. Now, at the time, that was the assumed rate for K non-HAS and still is the assumed rate for K non-HAS. In 2018, the assumed rate for C non-HAS was 6.25. So there was a difference in 2018, the last time this was reviewed, but it was determined for a lot of reasons that I'll let Danny speak to more eloquently than I could, that we came with a single rate, a rate that would be utilized by all the plans under the administrator of KPPA. And that ultimately is what we're looking to decide here, what we would recommend to the board, to the full C board, as to what that actuarial factor rate should be, whether it should be a single rate that is exclusive to us, I think is one camp, or whether it should be a blended rate that utilized both and recognized both C and K.
So it is K still 5.25 then?
It is.
And they're gonna have to have the same discussion.
And in fact, the C plan is still 5.25 until you take action.
Correct. And with that, Danny, I'll turn it over to you.
Ed, could I make one quick comment?
Yes, certainly.
Probably the biggest impact is when the person has a tier 3 balance and they retire and they convert it to an annuity. This is the interest rate that we use to determine how much monthly benefit they get by converting their balance into an annuity.
Yes. And there is no question that the lower that assumed rate, the lower the payment amount that the member would ultimately receive. So a higher assumed rate would benefit the member, and a higher assumed rate would allow the member to pay less when he or she purchased credit or purchased time.
And I'm getting a little bit confused. So it was, currently it's 525 for both K and C.
Yes.
But you mentioned 218 was raised to 625.
No,
That's not been activated. Is that basically what you're saying?
No, Danny, let me take that. In 2018, the assumed rate for C, the assumed rate of return was 6.25, but it was determined by the then KRS board that the actuarial factor rate should be for all plans, C and K included, and state police should be 525. So at that point, the C rate for actuarial conversion was 525.
It was changed.
Annie pointed out, it is that today until the C board takes whatever action it deems to take.
So it was in 2018, it was changed from 625 to 525.
No, it's always been 525, this actuarial rate. But I believe in 2017, the C non-has rate for all the plans went to 6.25. So that's the assumed rate. There are two separate rates, Dr. Hackbart. They are.
And I don't think the rate was 525. I think it was brought down to 525 in 2018.
Yeah, it was.
Along with the assumptions for each of the plans brought their rates down. In the case of the annuity rate, it came down to 525.
Okay. That's the rate that we're operating under today, 525.
I see. Okay, I'm clear.
Okay, there was a reason that, and it's, GRS has two comments regarding the annuity rate discussion. And that, on this, first and foremost, we believe that it does it for many reasons, including, just from a business case and from an equitable place, that the K and the C use the same assumptions for the conversion factors. And the thought is the K and the C, the benefits provided by the K and the C plans are essentially identical. There's not a difference in, if you have an identical set of twins in every single way, one's earning, takes a career in the K, earning benefits in the K plan. You have the other one that's earning benefits in the C plan. They both retire at the same date with the same earnings, same everything. You would think their benefits in terms of a monthly benefit would be the same. And so that's kind of the premise of the logic behind it, that one individual's not benefiting or harmed in any way, or differentiated because of a different set of assumptions that's adopted by the board, or differences by the boards in the assumptions. If we go to the very last page of the board book, and we got a lot of numbers here, but let's start here on the cash 3 balance factors as what they note. And so what we have across the odd, just hypothetical examples, so we can give you a magnitude of what we're talking about. Retirement age 55, 60, 65. Each case, their account balance, their hypothetical account balance at retirement's 200,000. if they were to retire under, if the benefit factors 525 as it is now, let's say, we'll take the middle column, age 60, then that $200,000 would convert to a benefit of $1,210, and that's a monthly amount. If the interest rate assumption was increased, you can see we have 5875, and that's, I believe, midway between 525 and 6.5. And then you've got 608, which I think is more of a headcount based approach. And then if you went all the way to 6.5, you can see how the factors change. And then what is the relative increase in the value of that monthly benefit compared to the baseline of the 525. And again, this is the single biggest component, I think, in terms of discussion of the conversion factors. If we look at service purchase, there are a few members that purchase service. It's supposed to be on an actuarial neutral basis. Although some systems build in that concept that they put in they use slightly more conservative assumptions because they know that it's still a great opportunity for a member to buy service and increase the monthly benefit versus taking that money, trying to go out to an insurance company or an annuity broker and trying to find that same income with that amount of money. It's more efficient, or they can provide more through the retirement system. You can see the impact there in relative percents. And then the last one, this impacts tier 1, 2, and 3 members of somebody who retires, again, 50, 55, 65. This time we're looking at a monthly benefit, and you can see, well, what if we use different interest rate factors? How does that impact the change in benefit from a life only, basic life only, to providing 100% survivor? And here, this is an example where interest rate assumption has very marginal or negligible impact on those conversion factors, because here what you're looking at is relative value of 2 benefits, 2 annuity streams, and the difference between the two is one of them has a survivor feature or survivor rider on it versus the basic life annuity that just extends to the life of the member. So that's your difference or relative value there. But the biggest, if we go back up to the top and the top 2 factors, we're discussing either you have an account balance, you're trying to convert it to a monthly benefit that you're going to provide for the rest of that member's lifetime. And how do you implicitly, what is the implied understated earnings assumption that is built into that factor?
Danny,
Yes, sir.
do you mind if Aaron speaks to the administrative aspect of 2 versus
I
1?
think that'd be great.
Not to put you on the spot, Aaron, but I just did.
No, that's okay. I was just looking for my mute button. Currently our technology structure for the administration of benefits is set up to only it's 1 factor used for all the plans based on the 1 assumed rate of return. If there were to be a difference, if we were to use different sets of factors, as they were discussing at the beginning, that would be a very large structural change to our information technology system that we currently use in place today. That would take a significant amount of time for programming. It also, in addition to the administration, just like Danny was saying, all things being equal for members who have both KERS and SPRS plans, in explaining and discussing member benefits with them, our counselors to be able to discuss the single rate versus multiple rates based on plan would make the administration of that much more difficult for that as well.
So would you calculate part of the benefit at 5.25 and part at whatever the other rate was, and then merge them? Is that the idea?
Well, it would be based on whatever their earnings in their
Right.
particular plan. So
Right, so
there's
if-
a benefit calculation for K and there's a benefit calculation for C. They get one for a payment in each plan.
And then each produce a dollar amount, and then you
Right.
get the combination.
Mhm.
Mr. Chair,
So we-
if I might,
Yes, please,
you know, one of the things that I would say to the committee is that irrespective of the rate that you ultimately recommend to the entire C board, ultimately, if we're going to get to one rate, the K board will have to agree to that rate as well. Right now, the factor is at 5.25. And one might think that that would be the most advantageous rate for the K board. So they might want to stay there. So in order for us to get to a blended rate, a single rate, we're both going to have to compromise a bit. The other alternative, as Aaron and as Dave have just laid out, would be we go to two separate rates. We each use our assumed rate and live with the administrative issues that would entail.
And I'm not sure there's an equity issue here too. When Danny talked about two twins having equal experience but getting a different benefit, there is an equity issue between the systems. I don't know that it's a C or a K issue by itself, but overall, there's an equity issue.
Yeah, that's the way we see it. We said we had a two-part recommendation. The first one was the equity between both systems. To us, if you're providing two identical benefits, they ought to be identical in all aspects between K and C. The second is if it comes down to what, you know, a particular assumption, currently you're 5.25. We don't see an issue coming off something higher than that, but that's going to begin into a discussion of with the KRS board about what their perspectives and policy is on that. When I see it at 5.25, you know, I say still, what's their alternative? So, you know, you look at somebody who's got a cash balance of $200,000. Can they take that $200,000? Can they go out to their annuity broker or investment company and buy an annuity that's provided by the plan? I don't think so. I still, you know, it's still the most efficient way for that member to get a guaranteed monthly benefit. So even at 5.25, if you go up something higher, that's to me what I'm providing you, or what that illustrates is how much additional risk are you taking on in guaranteeing that money. When you do it with an insurance company, annuity provider, when you have that initial transaction of $200,000, that's it. That annuity provider cannot go back and ask for any more money for that guaranteed benefit. It has to cover everything: administrative expenses, the benefit, anything else going forward. Whereas on the retirement system itself, you can absorb some risk and you don't have to provide. It's in that if something were to go different than expected, you know, you have an unfunded liability and it gets absorbed into the contribution rate that employers pay.
Yeah.
So that's why you can still provide a higher monthly annuity at a still a reasonable risk.
You know, I would say to that and the C board will vote for itself. I'm simply just giving some color to it. I don't see 5.25 as an operable rate for C, because there is no relation to the C board or its system at 525. There's nothing there for us. Something in the middle, if we were to split it, then we could say that both systems have given in order to get to a single rate. That's something that I believe the C board could defend their position on. But it certainly is, in my mind, and only my mind, and I don't have a vote, it's indefensible to say the 525 rate, because there's nothing in our system that is pegged to that assumed rate.
Danny, I don't know, Mike, this is your meeting, I guess, but I want to ask Danny a question if I could.
Sure.
Actuaries or GRS, I think, would have no problem if we move rates that enhance the financial strength of a system. I mean, you're not going to say, don't do 4.5. You're going to say, if you can do it, you can do it. But at some point, going the other direction, you as a fiduciary, not as well, you as the actuary, the advisor, are going to say that begins to be problematic for us. Is that fair?
That is fair.
I'm just wondering if will you ultimately provide an opinion that says that's about as far as we would be comfortable accepting as actuaries?
Well, I don't see a case for going above 6.5. So that's your upper limit. I think what you're looking here are the two limits. Keep in mind, whatever is ultimately adopted by the CRK plan does also get reflected into the valuation. So whenever the new conversion factors are incorporated in, which will probably be, it could be next year, it could be July 1, 2024, before the programming's in, the testing and implementation's ready. So it takes time.
This has not been this is the first time there's been a board discussion, but there's been discussion. There's been discussion with the CEOs and staff saying, can we seek a middle ground here somewhere that's acceptable to all parties? One middle ground is 5.875. I mean, it is the halfway point, and I didn't know whether you could weigh in on that, or it was appropriate.
If that's where we ended up, I think, Jared, I can speak for myself, is to me that would be reasonable and appropriate.
Okay. Well, that kind of answers the question I had on my mind in terms of equity, and I think that's a critically important consideration. I don't see having these two rates. I'm not sure how we justify that, but if you could do a blended rate, it would not be, did have not some negative effects that I don't know about. I think the blended rate's around, I didn't do the math, but it's around 5.87, something like that. I mean, is there a competitive reason not to blend the rates?
I don't have one as the actuary.
Well, I didn't have
Also
one either, but I didn't run the numbers like you have, so that's why I asked the question.
I don't as the actuary, don't.
It seems fair to me that we have, it'd be the same.
I was gonna say something and I lost my thought. Oh, I remember what it is now. So this also, keep in mind, this is not a forever factory set. That this is a side review, part of plan administration after an experience study has been adopted. So when the next experience study is performed in 4 years, we will look at the factors again, and may very well have this discussion again.
Procedurally, would the K board and the C board need to have a meeting of the minds on this issue, or what? How procedurally have we addressed this issue?
That would be our recommendation.
When does K meet? The K board?
I believe it's the 13th or 14th,
It's the 14th.
14th of
Yeah.
November.
Would we're trying to figure out the logistics of this, but would a motion by C contingent upon acceptance by K be a way to get around this?
I don't know why it couldn't be a recommendation though, subject to K board agreeing with us. We can always revisit the issue. We need to get,
Well,
we need to get the ball rolling though, and one, I
yeah,
mean,
maybe we simply make a recommendation to the C board to blend it,
yeah,
and then K could react to that.
that's my thinking, Dr. Hagbart, yeah,
Given that, I would so move.
okay. What is the blended rate? Somebody help me, I'm doing math in my head, I'm not very good at that. Would that be a,
5.875, Mr. Chair, is exactly in the middle of our two assumed rates.
I did that on my phone, so I was questioning myself, that's what I got too, so I feel better about it now, so. All right,
There's-
I'm sorry, do I have a motion to that effect? I'm sorry.
A second?
Okay, we got a motion, a second. Okay, I've got clarity in my own mind finally on that issue. Is there any more discussion or questions? Okay, let's vote on it before I get confused again. All in favor of the motion, say aye.
Aye.
Does anyone oppose? And that would be the recommendation. And that would go to the K board next. I guess that's what we have to do.
Right.
Yeah.
I guess it goes to the C board, and the information about it goes to the K board, just for their
Yes.
deliberations, right?
Then hopefully have a consensus and go from there. Okay.
Right.
All right.
On behalf of the K staff, we thank you.
All right, where are we now? I think I've exhausted the agenda I had anyway, but is there anything else we need to discuss this time?
No, sir.
By the way, I meant KPPA staff. I didn't mean KRS staff.
Okay, unless I missed something here, I'd be happy to entertain a motion to adjourn.
So moved.
A motion and a second.
Second.
If there's no objection by consent, we'll stand adjourned. Thank you, everybody.
Thank you, Mr.
Thank you,
Chair.
everybody. See you the 8th.
Everyone.
Bye-bye.